Hello all, welcome to this course on time series modeling and forecasting using R. Now this is a fresh week and a fresh new topic, and then of course you can see the topic in front of you. So the broad idea in the entire this week would be volatility modeling or volatility modeling, and in general we will call that to be stochastic volatility modeling. Now first we will again break each and every point into different aspects, and by the way this entire week would be slightly more applied because let's say if you take the area of finance, right. So let's say if you have some interest in, let's say, stock price forecasting, or let's say order book data set forecasting, so or let's say mid price forecasting. So all these things contain some volatile aspects in them. So firstly we will understand that what do you mean by volatility, and then we sort of break it down into the impacts of volatility, different kinds of volatility, and then eventually we will put forward some time series models particular to analyzing and modeling the volatility nature of a time series. So hence the name stochastic volatility modeling. So rather than the actual time series values changing, or rather than the mean changing, what would happen if variance also changes, by the way, right. So the entire stochastic volatility modeling is focusing more on changing variance aspect of a time series. Okay. Alright, so again we will see a lot of examples, do not worry. So since this is just a first session this week, we will try to put forward some introduction, we will give some examples down the line, and so on and so forth. Okay, so the first slide is a bit of an introduction. So far what we have seen is we have talked heavily on ARIMA model. So ARIMA is what? So auto-regressive integrated moving average models. And all the ARIMA models have a tendency of describing the mean development of a series, right. So if you pick up, let's say, even AR models, MA models, ARMA models, or in general ARIMA models, they have a tendency of only focusing on the mean of the series and then not the variance, isn't it? So when we try to model any practical time series data using an ARIMA structure, or let's say for that matter SARIMA structure, so both ARIMA, SARIMA, they only focus on the mean aspect of the series. This is the first point. Now the second point is optimal forecast. So the conditional mean of the model which minimizes the forecast error variance was taken to be the optimal forecast, right. So let's say when you put forward an ARIMA model and then try to forecast down the line, so how did you try to figure out the best forecast? So best forecast or the optimal forecast was the one where the conditional mean of the model which minimizes the forecast error variance. Now on the other hand, one can actually talk about something called as unconditional variances are time invariant. So when you focus on unconditional variances, now again do not worry. So in the subsequent slides I will also elaborate more on what do you mean by unconditional variances, what do you mean by conditional variances, etc. Okay. So the third point is unconditional variances are time invariant. So if you have a certain variance which is unconditional, which does not depend on anything, so such variances can be assumed to be time invariant. So time invariant means they do not change with time, basically. But the problem lies the moment you talk about conditional variances. So conditional variances keep on changing, right. So the conditional variances and covariances often depend on the magnitude of past shocks and past variability. So here the third point, again just to summarize very quickly, I will try to break it down in two parts. So you have two different kinds of variances. First one is called as unconditional, where you do not have any restrictions and hence the variances are not based on time, or rather they are time invariant. And the second kind of variances are called as conditional variances and covariances, which often depend on the magnitude of past shocks and past variability. So such conditional variances have a tendency of depending on its own lags, right, or rather its own past variability, etc. And then the last point is in modern economic theory, increasing role of risk and uncertainty considerations makes the modeling of time varying variances and covariances crucial, right. So these days you must have seen a lot of examples where suddenly something happens, some news comes in, and then the price sort of fluctuates very drastically. So all these aspects are kind of changing variance aspects, right. Just to give you a very brief graph just as a starter is that, let's say if you think of a stock price which kind of moves in this fashion, but suddenly due to some unforeseen news the price fluctuates very drastically, and here you can clearly see that you have some changing variance problems in the series now. So eventually you have some highly fluctuating prices, or rather returns, let's say, due to some external factors, but overall if you observe this entire series, then you can see that you have some variance issues here. So variance is not constant here, right, and hence we cannot model such series using simple ARIMA models and so on and so forth. We require to model the underlying volatility as well. There. Okay. So, the last point again just to summarize is that in modern economic theory, increasing role of risk and uncertainty considerations makes the modeling of time varying variances and covariances very crucial. So, I think this slide gives you slight motivation as to why should we even study volatility, or why should we put forward models to capture volatility, etc. Okay, so before we move forward with any of the modeling aspect, I will show you some very quick examples. So, the first example contains a chart of VIX. So, we have something called as the VIX index. So, VIX index is nothing but the volatility index. Okay. So, the full form of VIX is nothing but volatility index, and again probably I am very sure that many of you might already have an idea as to what you mean by VIX. So, VIX stands for how volatile the index is, or it sort of captures the overall variance of the index. Okay. So, by the way, each and every line or each and every bar that you see here does not signify any price per se. So, this is not a price plot, this is rather a plot of the underlying variance of the index, and hence it is called as volatility index. So, how does the index behaves from a volatile point of view or from a volatility point of view. Okay. Now, again here clearly the data is from January of 2010 all the way up to, let us say, I think December of last year, which is 2023, and here clearly you see that wherever you see peaks here, those are kind of thresholds and those are periods of heavy volatility, and on the y axis you can see the actual value of the VIX. So, for example, here this is exactly the COVID time. So, you see that the markets were highly volatile, and since the markets were highly volatile, the VIX shot up and the value of the VIX happened to be 80 around here, and again here you can see some kind of high peaks here. So, let us say the first peak would be somewhere here, the second peak is here. So, all these time points there was some activity in the market which kind of made the market to be highly volatile. So, again just to summarize, VIX is nothing but a graph which captures the underlying volatility of an asset. So, in this case it is an index. Okay. And now the second example could be, let us say, daily returns of the NYSE, so New York Stock Exchange Composite Index. So, this is exactly how the NYSE returns have been from 2018 to very recently, so in this year itself. So, again here you can clearly see that around COVID, since the NYSE was in fact very volatile, so you see that sudden disruptions in the entire behavior. So, you see lot of fluctuations in probably this area or again slightly here, right. So, all these large fluctuations kind of make the variance not to be constant, right. So, overall if you observe the variance here, so variance is obviously not constant. So, you have some constant part here, but due to sudden fluctuation the variance also goes for a toss. Okay. So, again just a small disclaimer that when I say these two things, they sort of mean the same thing, that changing variance in a real time series and the time series being volatile. Okay. So, if a time series is volatile, what it means is the variance keeps on changing with time. Okay. So, the sigma square that you see, sigma square itself is a function of time. So, you can actually say sigma square with a subscript t. Okay. So, again if a variance keeps on changing with time, we will say that the underlying time series is highly volatile. Okay. Okay. Now, the next thing is what all are the properties of volatility. So, the first one is there exist volatility clusters. So, in finance literature we have this important idea called as volatility clusters. So, what do you mean by volatility clusters? So, volatility is high for a certain time periods and low for other periods. Okay. So, let us say volatility, I will show you through a graph. By the way, volatility clusters means that if you see high volatility, that period is almost followed by high volatility, and whenever you have low volatility, that period is again followed by low volatility. So, initially in this series you see that the series is highly volatile, and down the line you see that the series is not that volatile. So, high or low volatility follows by the same kind of a volatility structure. So, high volatility follows by high and low volatility follows by low. So, such periods are called as volatility clusters. So, volatility often exhibits a clustering kind of a mechanism. Okay. Second property is volatility evolves over time in a continuous manner, that is volatility jumps are rare. Okay. So, what do you mean by that? That volatility does not jump usually. So, you will not see something like you have very highly volatile series and suddenly after a jump the series, let us say the variance kind of drops, right, because you don't see highly volatile nature here, but then such jumps are not very evident. So, it should be in a continuous manner, right. So, highly volatile periods and low volatility should be again going across the time scale in a continuous manner basically. Thirdly, volatility is often stationary and does not diverge to infinity. It sort of varies within fixed limits. Again, this is a very important point, that how do you, again remember, how do you capture volatility? So, you capture volatility by the length, or rather the height of all these fluctuations, isn't it? So, of course, variance can't go to infinity. So, right, it has to stop somewhere. So, even if you have really high spikes and really high volatility clustering, but again the peaks won't go to infinity, right. So, hence we say that volatility is often stationary and does not diverge to infinity. It sort of varies within some fixed limits. And last property is that volatility seems to react differently to a big price increase and a big price drop. So, if you see a big price increase vis-a-vis a big price drop, then the volatility kind of changes accordingly. So, for any big price increase, you will see a different volatility change. For any big price drop, you will see a slightly different volatility change. What you mean by this is that the big price drops usually have a greater impact. So, whenever a price drops, so price drops are much more drastic than price increases. So, whenever you have a downward sloping trend in the market, or whenever the markets are not doing, or rather not performing well, so the market is going down. So, during those times you will see highly volatile kind of structures rather than whenever a market is going up. Okay. So, again the big price drops usually have a greater impact. This phenomena is rather referred to as a leverage effect. Okay. So, this phenomena is referred to as the leverage effect. So, again these are some properties of volatility. So, volatility clusters, then how exactly can you specify volatility? So, volatility evolves in a continuous manner. Volatility can be assumed to be stationary, as it does not diverge to infinity, etc. And lastly, you have this very important leverage effect underlying the volatility. Okay, so I thought of putting couple of slides on changing variance. So, what do you mean by changing variance? So, firstly, we will try to understand these two technical terms. Probably we have revisited these terms even earlier. Okay, so a time series is said to be heteroscedastic. So, the first term is heteroscedastic. So, time series is said to be heteroscedastic if its variance changes over time. Okay. So, you have to keep this in mind, that whenever if you see changing variance, the underlying time series is heteroscedastic. As opposed to that, if the variance is not changing and the variance is rather fixed, then we will call such a series to be homoscedastic. Okay. Again, a very quick example could be, let us say you have a series which looks like that. So, this could be an example of homoscedasticity, because variance is kind of constant, but at the same time if you have a slightly different series which behaves like this, then you see some changing variance problems here. So, such a series is called as heteroscedastic. Okay. And second point is, whenever the variance is not constant, it follows a mixture normal distribution, and one can actually expect more outliers than expected from a normal distribution. That is, when a process is heteroscedastic, it will follow a heavy tailed or outlier prone probability distributions. Okay. So, again changing variance is a problem, right. So, whenever variance keeps on changing, all the normality assumptions, all the distribution assumptions go for a toss. So, whenever variance keeps on changing, we can't put forward a proper normal distribution on the errors. Okay. So, the error distribution won't be normal. So, the distribution on the errors would contain some heavy tails than a normal, or you might see some outliers in the distribution and so on and so forth. So, again heavy tailed and contains lots of outliers is again a problem, right, because normal distribution is not being followed. So, again just to summarize, whenever a time series is heteroscedastic, we end up in some problems like this. Okay. So, until the early 80s, econometrics had focused almost solely on modeling the means of the series, right. So, in the early 80s, they did not worry too much about the changing variance or volatility, etc. That is, their actual values. But very recently, however, researchers have started focusing increasingly on the importance of volatility, its variations and its effects on the mean values. So, along with studying the mean or modeling the mean, how can you sort of put forward a model to capture the changing variance also, or the volatility nature of the series also. So, henceforth a key distinction is between the conditional and unconditional variance. So, as discussed even before, that you have two different kinds of variances. First is conditional, second is unconditional. So, how do you differentiate between conditional variance and unconditional variance is the key here. Okay, a short description about what do you mean by conditional variance, what do you mean by unconditional variance, alright. So, the first thing is unconditional variance, and then unconditional variance is any common variance you must have studied in any other stats course before this, right. You do not have any restrictions here. So, unconditional variance is just the standard measure of the variance given by this equation. So, variance is nothing but expected value of x minus its mean whole square. Okay. So, expectation of x minus E of x. So, E of x is nothing but the mean and then whole square. But the moment you come down to conditional variance, things are slightly different. So, conditional variance is nothing but the measure of the uncertainty about a variable given a model and some information set. So, let us say this capital omega is nothing but some information set you have. And then on top of that, how do you condition based on that information set and then find the variance of that. So, such a variance is called as conditional variance. So, again if you see the formula is slightly different. So, expectation of x minus E of x given omega and then whole square. Okay. So, here in conditional variance you have this extra omega term here, which is nothing but the assumed information set that you already have. Okay. Now, the next thing is stylized facts of asset return. So, firstly you should understand what you mean by stylized facts. So, often in finance literature you have a thing called as stylized facts. So, stylized facts are nothing but some facts of that particular asset class, or let us say prices or returns, which cannot be proved, but which are seen almost every time. For example, let us say I will give you a small example. So, if you observe the price of any stock, then we often say that price increases and at some point it should slightly reduce and again increase. So, price need not go on increasing at a stretch. There has to be always these dips which come in. So, all these are stylized facts. So, stylized facts are such facts which cannot be proved, but which are visually observed or visually seen, or rather seen evidently almost every time. Okay. Firstly, thick tails. So, thick tails means that the tails, if you observe, if you have a changing variance problems, then as discussed before, the one can't put forward a normal distribution on the errors, and then hence the tails are thick, right. They tend to be leptokurtic. Okay. By the way, these are stylized facts of asset returns. So, asset returns have a thick tail. Second is leverage effect. So, the tendency for changes in stock prices to be negatively correlated with changes in volatility. So, what do you mean by that is that the changes in the actual stock price is rather negatively correlated with changes in volatility. So, if you have a highly volatile kind of a time point, then changes in stock price would be kind of again high. Okay. Third one is non-trading period effect. So, whenever a market is closed, information seems to accumulate at a different rate to when it is open. Obviously, so let us say you might see that markets might be highly volatile on a Monday rather than something like on a Tuesday or a Wednesday, when the markets have been open that week, right, because all the information sort of accumulates over the weekend. So, at the point where the market closed on Friday is completely or rather could be completely different from the point when it opens on Monday. So, one can actually observe slightly volatile periods on Monday if you compare to let us say Tuesday or Wednesday or Thursday, etc. Okay. And lastly, forecastable events. So, volatility is high at regular times such as news announcements or other expected events, or even at certain times of the day. Let us say example, less volatile in the early afternoon, right. So, again just to give you a small example, if you I am very sure that if many of you are sort of interested in let us say investing or trading, something like that. So, you should have observed that whenever the market opens for the day, right. So, the underlying price or the underlying asset or the underlying price of the index is highly volatile as compared to somewhere down the line, let us say 12 o'clock or 12:30 in the afternoon. Okay. So, volatility is high at regular times such as whenever let us say news announcements. So, whenever some erroneous news has to be expected, the markets are highly volatile, or rather other expected events, or even at certain times of the day. So, as discussed, let us say highly volatile in the morning whenever the market bell occurs, and slightly lesser volatile in the early afternoon. And again towards the end, whenever the market closes, again you might see some volatile aspects there. Okay. So, volatility again is sort of not constant over the day, right. So, it might be high in the morning, then sort of subsides down in the afternoon, then again sort of picks up in the afternoon, late afternoon, etc. Okay. Now, the next one is volatility and serial correlation. So, there is a suggestion of an inverse relationship between the two. So, if you talk about volatility and serial correlation, then one assumption is that there has to be some inverse or negative relationship between the two. And lastly, co-movements in volatility. So, there is considerable evidence that volatility is positively correlated across assets in a market and even across markets. So, let us say if you pick up two assets in the same market, then there is considerable evidence that volatility is positively correlated. So, I will give you a simple example. So, think of these two coins. So, on one hand you have Bitcoin, on the other hand you have Ethereum, and whenever there is high volatile structure in Bitcoin, you should see the same kind of a structure in Ethereum and vice versa, right. So, since these two asset classes come from the same cryptocurrency market, right, and then whenever you see some highly volatile time points in Bitcoin, you will definitely see some same kind of a structure or highly volatile time points in the Ethereum in the same duration. So, this is basically called as co-movements in volatility. So, two assets kind of co-move in terms of their volatile nature or volatility. Okay. Now, the next thing is a small primer on types of volatility. So, how many kinds of volatility are there, right? So, we will sort of describe that for a moment and then proceed ahead. So, in fact, you have 4 different kinds of volatility. So, the first one is called as historical volatility. So, firstly, what do you mean by that? So, what do you mean by historical volatility? So, calculated using the past data, it could be either returns or prices, right? So, the past data could be either returns or prices. Second point is historical volatility represents the standard deviation of returns over a specific time window in the past, right. And again, I have probably, if not in this lecture, maybe in the next lecture, I will sort of elaborate a bit more on historical volatility. So, how do you find it out? What are some of the limitations of that, right? But again, just to understand right now, historical volatility is nothing but a measure of the variance that has been occurred in the past. So, calculated using the past data or the past returns or prices. Second kind of a volatility is called as implied volatility. So, what do you mean by that? So, implied volatility is derived from option pricing models, example Black-Scholes. So, many of you might know that Black-Scholes is a really famous kind of a option pricing technique, right. So, such implied volatilities is kind of derived from any of the option pricing models. And what it does is that implied volatility represents the market's expectations of future volatility. So, rather than taking or finding variance on from the past data, what do you expect to be the volatile nature in the market in the future? So, market's expectations to capture the future volatility is given by implied volatility. The third one is called as volatility clustering, as discussed even before, that financial time series often exhibit periods of high volatility followed by periods of low volatility. So, this phenomena is called as volatility clustering. And this is a very common characteristic in asset prices and is captured by some models that we will study later on, like ARCH, GARCH. So, more on them later. So, these two are specific time series models which try to capture such volatility clusters. And the last kind of a volatility is called as realized volatility. So, what do you mean by realized volatility? So, the actual volatility observed over a past period, right. So, the realized volatility is nothing but the actual volatility observed over a past period in the history. And such a volatility can be estimated using any high frequency data. So, let us say minute by minute or daily returns, etc. Make sense? So, again, just to summarize very quickly, so let me go back a slide, and then the first kind of a volatility is called a historical, second one is implied, third one is volatility clustering, and then the fourth one is called as realized volatility. So, again, each of these different kinds of volatilities have their own advantages, have their own ways of finding volatilities, have their own pros and cons, right, when it comes to capturing the volatility. For example, again, if you go back a slide, the historical volatility revolved or rather focused entirely on the variance of the past data, right, or rather the variance of the past returns or prices, etc. And historical volatility represents the standard deviation of returns over a specific time window in the past. Implied volatility, the idea is entirely different. So, such a volatility is derived from, let us say, some option pricing models, for example, Black-Scholes or probably some other option pricing model, etc. And such a volatility represents the market's expectations of any of the future volatilities. And thirdly, again, just to summarize, volatility clustering. So, this is kind of the pain point here. So, this is exactly where we will try to put forward some time series models, for example, ARCH, GARCH, because such kind of a volatility clustering is often seen in, let's say, financial time series or day-to-day financial markets, etc. Okay. By the way, just to tell you the full form of ARCH, so ARCH is autoregressive conditional heteroscedasticity. Okay, so autoregressive conditional heteroscedasticity, and G-arch or GARCH is nothing but generalized arch. Okay. So, there has to be some autoregressive component to capture what? To capture the changing variance, because and what kind of variance? Conditional variance, right. So, autoregressive conditional heteroscedasticity. So, heteroscedasticity means that there should be some changing variance aspect, and what kind of variance? Conditional variance. And how are you modeling that? Using some AR model. Okay. So, one can either use the ARCH model or the GARCH model to model such changing variance aspects. And again, the last one is realized volatility, which is kind of similar to, let's say, historical volatility, but this is the actual volatility observed over a past period and can be rather estimated using some high frequency data. Okay, so now probably in the next lecture we'll try to elaborate a bit more on historical volatility. We'll try to put forward some limitations of that, and down the line we'll try to elaborate a bit more about one ARCH model, which is, let's say, ARCH 1, and then down the line again we'll discuss a few extensions of ARCH, a few more extensions of GARCH, etc. Okay. Thank you.